It really is, Kyle. I mean, those are some interesting findings once again. Of course, T0 still holds most of the market share and trading volume due to its expansive institutional broker network, right? And its permeation into the traditional financial markets. But we're really seeing that this is competitive advantage isn't necessarily enough to hold the demand of the market, right? I mean, that's one of the biggest swings we've seen in the market movement week over week. So this is also a good segue into our main topic, I think, because centralized liquidity solutions, they're not the only option out there. So today, we want to cover for our main topic, automated market makers and decentralized exchanges for security tokens. Shall we dive in, Kyle?
Absolutely. So when we mention the term decentralized exchange, I'm really referencing a platform to exchange two assets without a centralized party facilitating the transaction. There are many reasons why a centralized party has been crucial to this process in the past, including compliance enforcement, listing management, or issuer due diligence, but many of these traditional roles that an exchange plays can be automated through smart contracts instead of requiring manual intervention.
I mean, we've definitely covered many of those features and the benefits of smart contracts across a whole range of episodes in the podcast. So if you'd like to learn more about these, about how those things change with the blockchain, smart contract technology, go back and listen to those main topic clips. But on top of those things, which are being gradually phased out through smart contracts, decentralized exchanges handle asset demand much differently than traditional exchanges, right, Kyle?
Yeah, so that's where we're going to begin the discussion today because you see, a traditional centralized exchange operates an order book where buyers and sellers essentially post their highest and lowest prices that they're willing to pay for a certain asset. This order book, which is filled with those buy orders and the sell orders, is then matched by the exchange so that an order can be filled. Then, either the exchange or one of its market making partners can pocket the difference in the buy and sell price, known as the bid ask spread, to make a fee on the transaction. While this process can be recreated in a decentralized exchange, it has inherent flaws in addition to new problems when bringing the system on chain. For starters, this process is very reliant on those market makers to fill liquidity for each trading asset. Without many financial liquidity partners, an exchange would become immediately illiquid and therefore irrelevant. Because of this, market making is very expensive and results in heavy fees and a poor user experience. On top of that, market makers constantly adjust their bid-ask spread to account for changing order books, and with a rigid price structure of the order book, many transactions are canceled by users who are either unsatisfied with the delays in filling their order or due to not finding the price that they were seeking. So now if we take this process on chain where each transaction has a corresponding gas fee and a set amount of transactions that can actually only be approved in any given time, this process can very easily result in clogged networks that don't work for anyone at all, like we've seen in multiple times in the past.
So this is, an inefficient process, and it's only compounded by blockchain technology leveraged by security tokens in this case. But I also suppose it's only been a matter of time for these changes to take place. However, in order to change the minds of traditional users and institutions, more importantly, the promise of future change or innovation is not usually it's not enough to drive adoption. So in the context of exchanges, in order to kind of sway the tide of public opinion, quantified through trading volumes on centralized exchanges versus decentralized exchanges, let's say, these new blockchain-based exchanges needed to develop a system that capitalized on the opportunity to improve the user experience while reducing the fees, but most importantly, improving inherent liquidity without, of course, relying on third-party market makers.
And that's our perfect transition into automated market makers, known as AMMs, that are leveraged by exchanges like Uniswap, Balancer, or Curve. Each of these exchanges use a concept known as a liquidity pool to fuel trading on the platform, and then they use slightly different algorithmically determined price functions to adjust the price of an asset to reflect changing demand. So to review liquidity pools in more detail, I would definitely suggest going back to listen to the main topic of episode 64, where we break it down in much more detail. But in summary, asset holders would be incentivized to stake their security tokens into a protocol alongside a base currency like USD or Ethereum, and their own staked funds represent the counterparty to any trade of a given asset. In exchange for putting up the capital and risking that in the protocol, they're rewarded with trading fees proportional to how much of the pool they contributed. So when we use that idea of a liquidity pool and look at Uniswap, they're certainly best known for taking advantage of this, and they use a constant product market making function which acts to balance the supply of both of those assets in a liquidity pool by adjusting the price. In Uniswap's case, it aims to hold the supply of the two assets the same and then will asymptotically adjust the price as the size of the bid increases. This allows Uniswap to fill pretty much any order without issue, but the buyer doesn't necessarily be able to guarantee their price per unit on a given trade.
Okay, so let me summarize that point for our audience in an example. If I want to buy 100 shares of a real estate property on Uniswap, my price per share will increase with each additional share that I purchase. In this way, I can be sure that if I really wanted 100, I will be able to get it, but I can't exactly guarantee the price that I will pay. In this way, I also don't have to sit there and wait for my specific price demand to be filled in the same way that I would on a traditional exchange. On top of that, since it's determined by a price function and not an arbitrary bid-ask spread, set by a market maker, I don't have to pay that pass-through fee, right? There's no more middleman that I have to worry about in this non-centralized solution.
Exactly. So the ratio of tokens in a liquidity pool dictates the price of the trading pair. As you buy 100 of those real estate tokens from an Ethereum pool, you're effectively removing that supply in real estate and then adding it to the supply of Ethereum, therefore reducing the price of Ethereum as supply increases and increasing the price of real estate as that supply decreases. The amount of the price change is solely dependent on the size of the trade in proportion to the size of the total pool, right? Because the bigger the liquidity pool, the smaller the change in price because it doesn't matter that you only bought a couple shares. Whereas if you bought a ton of the shares of the total liquidity, clearly that's going to cause a bigger change in price, and those price changes would be known as slippage.
Right, so I think that all makes sense. So Kyle, why don't you tell our listeners what are the differences between what Uniswap has done with its constant product market maker and what, say, Curve or Balancer has done with their iterated automated market maker functions, right?
Yeah, there's a lot of jargon here, for sure. So Uniswap really pioneered this model in 2018, and it rose to prominence during the DeFi summer this year, but there were some clear improvements that could be made in order to improve on the user experience. For example, as we described in the Uniswap liquidity function, the algorithm strives to maintain a 50-50 reserve ratio between two assets, right? So you have the same amount of the two things in a pool. Because, in theory, if we force any liquidity provider to put in a 50-50 ratio from the start, and after a given time the ratio has skewed really strongly in favor of one asset versus another, that would be a pretty strong signal that suggests that the current exchange price hasn't found an equilibrium, right? It sounds like that's imbalanced, that the price is wrong. You need to change that price. And so while this is generally a very strong conclusion to make, it doesn't always tell the whole story. So while Uniswap just had it apply for every token, every asset, that same pricing function that changes, Curve realized that one glaring exception was for assets with very similar prices, most notably with stablecoins. So you see the demand for stablecoins has absolutely exploded in the last 18 months, as we've noted both on the show and various research articles posted by the Security Token Advisors team. And with these assets, the exchange price of one US dollar denominated stablecoin to another realistically shouldn't change very much because they're both stablecoins for US dollars. It doesn't matter regardless of the changing supply of the liquidity pool. So maybe a few cents or whatever due to increased adoption of one or another, but it definitely should not become exponentially different as long as you trust that both assets are really worth $1. Therefore, to solve for this pricing function improperly balancing the prices of two stablecoins on Uniswap, Curve created a specific algorithm, which was a hybrid of that constant product algorithm and a separate function known as a constant sum algorithm that leverages an amplification coefficient that adjusts the price change to allow for more cushion as the supply of one asset or another changes, which essentially prevents those huge swing in prices between two assets as long as the ratio isn't too skewed. So the price is still going to adjust, but for the most part, not as much.
Now, that's good in theory, but not always in practice, right? So due to changing demands, of course, for specific stable coins, due to the integration of the blockchain that they were built on, for example, significant supply shocks did actually happen. And in this case, the price still went way out of ratio, enabling savvy investors to capitalize on these arbitrage opportunities between two similarly priced assets. It's also another way of saying yield farming. And Curve was one of those main platforms allowing users to take advantage of of this phenomenon. It's also part of the design, though, as these functions rely on arbitrage opportunities in competitive markets to bring the prices back to equilibrium. So if the price is out of whack, then you can be sure that traders will take advantage of it, quickly closing that price discrepancy and bringing it back to where it should be.
Then, to add to the efficiency of liquidity pools beyond basic strategies employed by Uniswap and Curve, Balancer pioneered the idea of multi-token liquidity pools, enabling up to 8 assets to be locked into a specific liquidity pool that actually adds more stability to the pool by adding less correlated assets to prevent against a liquidity crunch due to the price shock of one of the 2 assets in the pool.
Aha, so Balancer actually here realized that when there is an asymmetric demand, it can crash the price of one asset. And so when that same asset that just crashed represents 50% of the liquidity of the trading pair, it of course crushes the liquidity too, resulting in even less liquidity and lower prices in a compounding manner, if you will. So the lack of diversification of the pool here created a concentration risk.
Exactly. And so what they created is known as the constant mean market maker, which takes the mean of all of those different assets, that's where you get it, and allows for the liquidity of prices of assets to be dictated by the general market in a better way, and allows the function to draw on outside factors to determine the proper exchange rate for given assets. So all these variations are fascinating and are constantly iterating on each other in the current order book model that was established by traditional exchanges way back in the day. So no matter which function you use, they reduce fees, they can improve liquidity in some cases, and reduce market cornering opportunities that are sometimes seen by market makers that can control the whole supply and then dictate what the price is.
But like you said in the beginning of the episode, Kyle, none of that matters unless you can drive the liquidity and adoption of the technology itself. So while these are all innovative developments, sometimes the more basic solutions are the ones that end up being favored by the market, which explains still why Uniswap is king of the DeFi jungle, at least for the time being due to its size. And we'll see if they keep it up. And any of all these programmatic pricing functions can compete at the highest levels of finance here.
Yeah, that's something still to be seen, whether these automated market maker functions can really truly replace the traditional market makers, or if they'll always kind of be second place. But that's all we got for you today. So this was a breakdown on automated market makers and how they work with decentralized exchanges. And if you have any questions, please feel free to reach out to me or Herwig on Twitter or LinkedIn for more information, questions, comments, or concerns.
And as always, we post our main topic clips on YouTube, so you can go back and review any of these concepts we've covered in the past anytime. And also, don't forget to submit any news or events to stomarket.com/news, and you may just get it covered on next week's episode. So thanks again for listening. I hope you enjoyed the show.
Talk to you next week on Tuesday.